Before you dismiss this as just another conversation about silver prices, stop for a moment and really think about what it means to hold something like 500 ounces of silver today. Because at that point, you are no longer just sitting on a passive investment. You are part of a much larger shift that most people still don't fully recognize. This isn't about a small price move or a short-term trade that comes and goes. This is about a deeper change in how wealth is stored, protected, and ultimately revalued when the system itself begins to feel pressure. Most investors believe they understand why they own silver. They see it as a form of insurance, a quiet protection against inflation, something that stays in the background while everything else in the financial world continues as usual. But that idea depends on one critical assumption: that the system remains stable enough for silver to stay in that passive role. And right now, that assumption is starting to break. The real question is not whether silver will go up next week or next month. The real question is what silver represents when the entire financial environment begins to shift. Because history has shown us something important, major turning points never arrive with clear warnings. They don't come with announcements or obvious signals. They begin quietly, almost invisibly, while most people continue focusing on the same assets, the same narratives, and the same strategies that worked before. Then something changes, and by the time it becomes clear to everyone, the opportunity to position properly is already gone. And right now, silver is sitting right in the middle of that kind of transition. For years, silver was ignored. It moved sideways. It frustrated investors who expected more. Money flowed into other areas: growth stocks, speculative plays, easy gains. That environment trained people to stop seeing silver as something important. But markets don't care about comfort or habits. They respond to pressure. And when pressure builds over time, the system eventually adjusts whether people are ready or not. This isn't speculation. This is structure. For a long time, silver pricing was controlled mostly by financial systems, futures markets, derivatives, algorithm-driven trading. On the surface, it looked like supply was always available and easy to access. But beneath that surface, the real world was telling a very different story. Demand for silver has been rising steadily, not because of hype, but because it's needed. Modern systems depend on it. Energy infrastructure relies on it. Advanced electronics require it. Telecommunications, medical technology, data systems, silver is quietly built into all of them. As the global economy becomes more connected and more dependent on technology, silver's role continues to grow in the background. At the same time, supply hasn't kept up. Mining output hasn't increased in any meaningful way. New discoveries are limited. Costs keep rising. Political issues and environmental restrictions slow everything down. This creates a situation that markets can ignore for a while, but not forever. Because when demand rises and supply stays tight, pressure builds, and pressure doesn't disappear. It accumulates. Now, this is where most investors misunderstand what's happening. They expect major moves to look clean and obvious, a smooth trend, a clear signal, something easy to follow. But real transitions don't work like that. They are messy. They are uncomfortable. They create confusion. Silver doesn't start moving in a way that reassures people. It starts moving in a way that tests them. You see sharp rallies followed by sudden pullbacks. You hear conflicting opinions. Analysts argue about whether the move is real or artificial. But all of that noise is not the signal. The real signal is the change in behavior, and silver's behavior is starting to change. It is no longer acting only like an industrial commodity. It is beginning to show characteristics of a monetary asset again, and that difference matters more than most people realize. Industrial commodities usually rise when economic growth is strong. Monetary assets rise when confidence starts to weaken. And right now, confidence in parts of the financial system is quietly being questioned. Most investors are looking in the wrong direction. They are watching stock markets, interest rate decisions, earnings reports, but underneath all of that, something else is happening. The bond market, which has long been seen as the foundation of financial stability, is beginning to show signs of stress. For decades, government debt was considered safe. It was the anchor that held everything together. Investors believed central banks could always step in, always stabilize the system, always maintain order. But that belief is now being tested. Years of low interest rates encouraged massive borrowing. Governments increased spending. Corporations relied on constant refinancing. Debt grew everywhere because it seemed manageable. But debt behaves very differently when interest rates rise. What once looked stable can quickly become fragile. This is why volatility in bond markets is increasing in ways that experienced investors recognize as unusual. And when the foundation of the financial system starts to weaken, money begins searching for alternatives. That shift doesn't happen all at once. It starts quietly. First, a small group of investors begins to hedge. Then larger institutions adjust their positions without attracting attention. Eventually, the broader market starts asking questions. And by the time those questions are being asked openly, the shift is already underway. And this is exactly where silver becomes important again. Because silver sits at the intersection of two powerful forces. It is both a monetary asset and an industrial necessity. When financial systems weaken, demand for monetary assets increases. When technology continues to expand, industrial demand stays strong. Very few assets exist in both worlds at the same time, but silver does. And because the silver market is relatively small, even a small shift in capital can create a large impact. This is why silver doesn't move slowly when conditions change. It doesn't adjust politely. It reprices, and it does so quickly. If you own 500 ounces of silver, you need to understand what that means today. Because ownership is no longer passive. It is becoming strategic. And once that shift happens, everything changes. This is no longer about predicting price movements. It's about recognizing a transition that is already beginning to unfold beneath the surface. Now, you need to take this understanding one level deeper, because what we are talking about is not just silver itself, but the structure of the entire system that assigns value to everything you own. Modern financial systems are built on credit. Governments borrow to fund spending, corporations borrow to grow and refinance, and consumers rely on credit to maintain their standard of living. For decades, this system expanded smoothly because borrowing costs remained low and liquidity was easy to access. It worked because it could keep expanding, but no credit system continues growing forever without consequences. At some point, the total level of debt becomes so large that it requires constant support just to stay stable. And when interest rates begin to rise in that environment, pressure spreads quickly across every layer of the system. Governments suddenly face higher interest payments. Corporations deal with tighter financial conditions. Consumers feel the strain through reduced access to credit and rising costs of living. This is not theory, it is how leveraged systems behave. And right now, those pressures are starting to show. Global debt levels are already at extreme levels, and deficits continue even during periods of economic growth. Central banks are now in a difficult position. They need to control inflation, but at the same time, they must prevent instability in a system that depends heavily on low borrowing costs. These two goals don't align easily. Tightening policy can reduce inflation, but it also increases stress across debt markets. On the other hand, loosening policy can support stability, but it risks weakening the purchasing power of currencies. This creates a tension that cannot be resolved cleanly. As that tension builds, confidence begins to weaken. Not all at once, not in a dramatic collapse, but gradually. And this is where most investors fail to recognize what is happening. They are trained to wait for clear signals, for obvious events that confirm a shift. But structural changes don't arrive with certainty. They develop slowly, through small changes in behavior that accumulate over time. Large institutions begin adjusting their positions quietly. Hedge funds increase their exposure to real assets. Even central banks begin expanding their holdings of precious metals. These moves don't make headlines immediately, but they redirect the flow of capital. And capital flow is what ultimately drives markets. Silver sits directly in the path of that movement. Unlike financial assets, silver does not depend on trust in policy or institutions. It doesn't require balance sheet expansion to maintain its value. It exists independently, supported by physical scarcity and real-world use. That independence becomes more important when confidence in the system begins to weaken. But silver is not just a monetary hedge, it is deeply tied to the modern industrial economy as well. And this dual role makes it especially sensitive to the environment we are entering. Look at the world around you. Energy systems are shifting toward electrification. Renewable energy is expanding rapidly, and these systems require materials that can efficiently conduct electricity. Silver is one of the most effective conductors available. Solar panels depend on it. Electric vehicles require it. Data centers, communication networks, sensors, and advanced medical technologies all rely on silver in ways that are difficult to replace. This is not a temporary trend, it is a long-term structural transformation. Industrial demand for silver is not based on speculation. It is based on necessity. At the same time, supply remains constrained. Mining is not something that can quickly adjust to rising demand. New supply takes years to develop. Projects face regulatory challenges, financing difficulties, and operational risks. Environmental restrictions add further delays, and a large portion of silver production comes as a byproduct of mining other metals, which means supply cannot respond directly even if prices rise. Demand can increase quickly, but supply cannot. This imbalance creates tension within the market, and when markets experience sustained imbalance, they don't correct themselves slowly. They reprice to restore equilibrium, and that repricing is often sharp and decisive. Now consider the scale difference between silver and the broader financial system. Global stock markets represent tens of trillions of dollars. Bond markets are even larger. Institutional investors manage massive pools of capital that must be allocated somewhere. In comparison, the silver market is extremely small. This creates a powerful dynamic where even a modest shift in capital can have a significant impact. It doesn't take a global consensus to move silver. It only takes a shift in attention from a relatively small portion of global capital, and that attention is beginning to change. This is why silver has a history of sudden, powerful moves. It remains quiet for long periods while underlying conditions build. Then, when capital starts flowing in, the price adjusts quickly. Investors who wait for clear confirmation often react too late. Instead of positioning early, they end up chasing momentum. This is where perspective becomes critical. If you hold 500 ounces of silver, you are not simply holding a physical metal. You are holding exposure to a system that is going through a transition. And transitions are never smooth. They are volatile. That volatility creates doubt. It creates hesitation. It makes investors question their decisions. But volatility is not always a sign of weakness. Often, it is a sign of change. Periods of calm usually reflect stability or complacency. Periods of turbulence reflect adjustment. Markets moving from one equilibrium to another do not follow straight lines. They move in waves of uncertainty. During those waves, ownership shifts. Short-term participants exit positions. Long-term holders accumulate. Institutions slowly build exposure. The nature of the market changes from speculation to conviction. Silver has followed this pattern many times before. Long periods of neglect, followed by sudden attention, followed by rapid repricing. And each time, the explanation seems obvious only after the move has already happened. But the conditions that created those moves were visible much earlier. They were simply ignored. Today, many of those same conditions are present again. Debt levels remain high. Monetary policy is constrained by competing objectives. Inflation pressures continue to influence decisions. Governments still rely on borrowing to sustain spending. All of these forces push investors to reconsider how they protect their wealth. Silver becomes part of that conversation, not because of hype, but because of its position within the system. It reflects deeper forces, and when those forces begin to align, the impact is rarely subtle. This is not about predicting a specific price or outcome. It is about understanding direction. And once direction is established, it often continues longer than most investors expect. That is the part many people underestimate, the persistence of a structural shift once it begins. Now take this one step further, because understanding the structure is only part of the picture. The real shift begins when perception changes. Markets are not driven by data alone, they are driven by belief. And once belief starts to shift, it can reshape the financial landscape much faster than most people expect. For a long time, investors operated within a familiar system. Governments issued debt, central banks stabilized markets, bonds provided safety, and equities delivered growth. Precious metals existed on the sidelines, mostly ignored unless there was extreme stress. That system worked because confidence remained intact. But confidence is not permanent. It depends on conditions. And when those conditions begin to weaken, behavior starts to change quietly at first. Investors begin to question assumptions that once felt unquestionable. They start asking whether the system can continue operating the way it has for decades. They look for alternatives not out of panic, but out of necessity. And once that process begins, it rarely reverses quickly. You can already see signals forming across the global economy. Debt continues expanding across developed nations. Fiscal deficits remain persistent even during periods of growth. Central banks are trying to balance inflation control with financial stability, and there is no easy solution. Tightening policy creates stress. Loosening policy creates inflation risk. Every decision carries consequences, and investors are beginning to recognize that reality. This recognition changes behavior. Institutional capital does not wait for headlines. It moves quietly, reallocating gradually before the broader market fully understands what is happening. And when enough capital starts moving in the same direction, the effect becomes visible. Silver is positioned directly within that shift. It is not just a commodity, not just an industrial input, and not just a hedge. It is also a signal, a reflection of confidence in the monetary system, a reflection of trust in currencies, and a reflection of how investors respond to structural pressure. Signals like this don't appear randomly. They emerge when underlying conditions begin to change. Now think about how markets behave during these transitions. Most participants do not act early. They wait. They look for confirmation. They rely on consensus. But by the time consensus forms, the opportunity has already shifted. Early stages always feel uncertain. They feel uncomfortable. They lack clear validation. That is why most people hesitate. But hesitation comes at a cost, because once attention returns to a market that was previously ignored, capital begins to follow. And when capital flows into a small market with limited supply, price movement accelerates. This is why silver does not move in a smooth or predictable way. It moves in phases, long periods of quiet accumulation, followed by sudden bursts of activity, followed by volatility that tests conviction, followed by continued movement that surprises those who hesitated. This pattern has repeated itself many times throughout history. Each time, the sequence is the same: neglect, accumulation, recognition, and then repricing. The only difference today is the scale. The global financial system is now larger, more interconnected, and more dependent on continuous expansion than ever before. And when imbalances form inside large systems, the adjustments required to correct them are rarely small. They tend to be significant. Now, if you own 500 ounces of silver, the meaning of that ownership becomes very clear. You are not holding something insignificant. You are holding an asset that exists outside the promises of the financial system, an asset that does not depend on policy decisions to maintain its value. It participates in both monetary protection and industrial demand. That combination is rare, and rarity becomes important when conditions begin to shift. But there is something else you need to understand. Ownership alone is not enough. Understanding determines how you respond when volatility increases. And volatility will increase. That is not a possibility, it is a certainty. The real question is how you interpret it. Do you see volatility as instability? Or do you recognize it as part of a transition? Do you react emotionally when prices move unpredictably? Or do you stay grounded in the structure you now understand? This is where most investors fail. They understand the reasoning during calm periods, but when the market becomes uncertain, when prices swing, when narratives conflict, they abandon their position at the exact moment the cycle begins to accelerate. And that is how wealth transfers happen, not because people lack information, but because they lack conviction. Those who understand the cycle early position themselves before the shift becomes obvious. Those who wait for confirmation enter after the move has already begun, and once momentum builds, it rarely slows down for late participants. That is why this moment matters. Not because of a headline, not because of a short-term prediction, but because the structure itself is changing. The environment around your investment is evolving. When silver ownership shifts from passive to strategic, everything changes. This is no longer just about diversification. It becomes about positioning within a system that is under pressure. It is about recognizing that cycles do not last forever. It is about understanding that when trust begins to weaken, capital begins to move. And when capital moves into assets like silver, the response is rarely slow or controlled, it is decisive. The real question is not whether this shift will happen. The real question is whether you will recognize it early enough to understand what it means for your wealth. Because by the time it becomes obvious to everyone, the repricing has already begun.